Hello System Traders, this is Jeff from System Trader Success, and I wanted to demonstrate the strategy code, the market divergence tool provided by Murray in a recent article on System Trader Success. So what I have here is a daily chart of the ES market at the top pane and the YM market in the bottom pane. And what this is the futures market of the S&P E-mini at the top and the mini Dow at the bottom. So the two futures contracts, the big ones for the U.S. markets, the S&P and the Dow. And we can I brought these up to show that these are, pretty well correlated. So for example, when the S&P is climbing up here to new heights, so is the Dow. Then it falls, the S&P, so does the Dow. And if you just kind of eyeball this, we can see that they're pretty well correlated, which makes a lot of sense, right? That's kind of what you would expect. Now, the whole idea of market divergence is what we're going to look for is where one is behaving differently than the other. Now, this doesn't just have to happen with stock index. Of course, this can be correlated, or two markets can be correlated, whether they're stocks, ETFs, or futures. I'm just going to use these as an example because everyone's very familiar with these, and often you can get access to this type of data relatively easy. So, with that in mind, I'm going to switch charts now. Okay, I brought up another chart. Again, we have the ES at the top and YM at the bottom, but I switched over to a 60-minute chart. And also what I have is this is starting from the end of 2013, so 12/31, so December 31st, 2013, going back, I believe, just about 5 years or so. And that's what we're going to call our in-sample data. And we can see we have the same stuff, the same settings, obviously, for YM. So again, we know that these markets are correlated. And so what we're going to have is we're going to have ES going to be our tradable. Our tradable instrument is going to be the S&P E-mini, and that's in our top frame. The bottom frame is going to be our intermarket. The intermarket is what we're going to use to generate signals from, and this is going to be on our second data stream, and it is our intermarket. And what we're going to look for is divergence. So what we want to see is the YM creating, we're going to be going long only in this example. And so what we're going to want to see is YM trigger a long while the S&P is still in what we consider a bearish or neutral state. So we're going to want to see YM generating a bull signal while we're still in a bear state on the ES. And what that means is, for example, let's say in this big pullback here on the S&P, what we're going to want to see is if a trade would be generated. I'm not sure if it would on this particular example, but we would see YM push strongly well before or just before the ES, signaling that we're going to take a long. And this will get a little clearer once we get in here. Now, what Murray has done is used a simple moving average as a trigger. So let's insert Murray's strategy, and I'm going to activate it here. And what we're going to look at, I've already gone through and optimized, but for the sake of this, let's go through the settings real quickly here. So this is the long and short bias. What this means is we're going to go long only. If we switch this to 0, you can see that we're going to be alternating between shorts and longs. But I'm just going to focus right now on the long side. So I'm going to put a 1 in there. And then go to type. There's two different types of way of calculating the divergence. We use type 1, which is a simple moving average. If you put 0 in there, it's going to compute it by taking today's close and comparing it to a close X bars ago or N number of bars ago. So you can explore that, but right now for this example, we're going to use a value of 1, which is just simply applying a moving average. And then the next two are the actual look back periods for the moving average. Now, the first one, LENTR, that's going to be our tradable. So in our case, this is going to be the top pane. It's going to be the S&P E-mini. And the second one, of course, then is the length of the intra-market, in this case, the YM market. So those are the two moving averages applied to those markets. And the last one is the relationship between these markets. One, we have they're correlated in a positive manner. Negative correlation, you would enter 0. But again, we're using a positive correlation. The ES market and the YM market tend to move in tandem. Now, to make this clear on what's going on here, I've gone in and added the moving averages. So let me just go back to the strategy. You can see for our tradable, we have a length of 31. And on our intermarket, we have a length of 10. Now, I did optimize those. I'm going to show you what I did with that in a little bit, but I just want to get the concept down here on what's going on. So let me insert. You can see I inserted moving averages here. Let me turn these on, and we'll see what we got going here. Okay, we can see we have our moving average applied. So here's our moving average on ES and then the one down here for YM. So let's try to find a clear example here as demonstration. I don't know if that one's so clear. Here's a good one. So if you take a look, we're going long here in the ES, and we're taking that Q off of YM. Now, why did we go long down here in the ES market? Well, if we take a quick look down here at the YM, we can see that the ES and the YM have both been in a severe downtrend for several hours. And what we're going to look for is the first bar to close above its moving average on the Dow. So when you go to the mini Dow down here, you can see that this green bar that I'm on right now closed above the moving average. But yet on the ES, it's still well below the moving average. So we got our close above the moving average on YM, but yet we're still below on ES. That's our divergence, right? These markets, the theory is they should be moving in tandem and behaving similar. So we see YM beginning to flatten out and push above that moving average. Thus, we're going to call that, hey, it's starting to enter a more bullish phase, but yet the ES is still clearly in a bearish phase. Let's get in. So that's our divergence we're looking for. We're comparing it to a moving average. Yes, the moving averages are different in length. They probably don't necessarily have to be, but this was through an optimization. So this is triggering our divergence. In other words, the YM is leading us as it crosses that moving average. We're going to go long, and that's what triggered that. Likewise, on the sell signal over here, we have the first time where we have a divergence. In other words, the close of the YM happened while the ES is still above. Now, see, you can look in other locations. Well, you know, why didn't it close in any of these? Why weren't they? Because they weren't in divergence. They were actually correlated, and as the ES fell, so did YM. So you can see this isn't a trading system per se. It's a tool to help you locate possible entries. And you can see that we're going to look at the strategy performance report, and it's going to look pretty impressive. All right, let me bring up the performance report on this. This is the equity graph, and here is the performance. It looks pretty good, right? I mean, this is just a few lines of code, and the only thing that I optimized was the moving averages. And they do seem to be rather robust. There's a wide variety of moving averages that produce decent results. So it does seem to be rather robust. This also includes $30 of round trip slippage and commissions and we're starting out with a $100,000 account trading only one contract, so keep those settings in mind. Again, it's long only. We have $34,900 in profit since the start of 2009 up to the conclusion of 2013. 1.38 profit factor. We have over 400 trades. We have 67 profitability. 67% are profitable. $83 in net profit. That's our average trade net profit, and we have a drawdown of around 11%. So again, this in itself is not a trading system, right? We don't have stops in here. We don't have any other filters or rules or money management or anything like that. This hasn't been tested thoroughly on out of sample or on live market. But look how easy. I just loaded this up and optimized these two moving averages, and we get a really decent performance graph. Now, if you were to take this into a trading system, of course you want to add stops. Maybe you'd want to add different filters or even exits. Murray points out in his article, there's possibility of gaining more profit per trade by having a more dynamic exit, some other type of exit technique. But this can definitely be used for generating signals. Now, again, what we're looking at is the in sample, and this is what was optimized. So let's move this to the out of sample segment, which I have another chart here with the same settings, same strategy, obviously, and it's on the out of sample data. So this is unseen data. We turn the strategy on. So the out of sample is going to be from, let's go back to the in sample just to show you. Again, from 2009 to the conclusion of 2013, that was our in sample. Out of sample. Okay, the out of sample has been applied. Let's bring up the equity curve. So here's the equity curve. Now let's go to the end of our in sample, which was the conclusion of 2013. And that's about, it's right around in here. There's 2031, right at this peak right here. So from here on is the out of sample. And you can clearly see that the in sample and out of sample look pretty similar. And let's take a look at the performance results. And we're getting about $82 in profit per trade and 1.45 profit factor. So we can clearly see that the out of sample data is matching the in sample data. So this is really a good sign. So I think this tool is extremely interesting, and I would be interested in pursuing this more. And I hope you find this helpful. Now again, you can get the strategy code for this as well as the workstation, the TradeStation workspace for this. If you're not using TradeStation, the text version of the strategy code is available, and it's really dead simple to code over to your platform of choice. It's only a few lines. You're going to look at it and see how simple this is. Now, in closing, I want to show you really what I did when I first loaded up the ES and YM on here. I just optimized 2 to 50 in increments of 2 for both of these parameters. And I just let that run, and what I picked was a stable kind of region, not the best one, but a mid-ranged area. And that's as much as I did right there, and I then applied it to the out of sample and then compared it to the in sample. So I hope you find that helpful. Again, you can explore all kinds of other relationships between different markets, and I think this can be a fantastic tool for generating robust signals. Again, this isn't a complete trading system. It is a tool to help you locate these type of relationships between markets and to help pinpoint possible entry points. Add a few stops in here, add some other filters. Hey, what about a regime filter? That may help a lot. And overall, after some testing, you might just generate a very profitable trading system. So I hope you find this useful. Thanks a lot for your time, and we'll see you on the website at System Trader Success. Take care.